Do you know what's holding you back from a better credit score? It might not be what you think. Let's debunk some common myths about credit scores that could be impacting your financial decisions. Welcome back to Money Skills School, where we break down financial concepts to help you make smarter money moves. Today, we're diving into the world of credit scores. Your credit score is like a financial report card, influencing everything from the interest rates on your loans to your ability to rent an apartment. Yet there are so many myths and misconceptions surrounding credit scores that can lead us astray. Understanding these myths is crucial, as they can impact our financial decisions in ways we might not realize. So let's debunk these myths and set the record straight. First things first, let's begin by defining what credit score is. What is a credit score? Your credit score is a 3-digit number that represents your credit worthiness, or how likely you are to repay borrowed money. It's based on information in your credit report, which includes your credit history, current debt, payment history, and other factors. Credit scores typically range from 300 to 850 in the United States, with higher scores indicating better credit worthiness. A higher credit score can make it easier to qualify for loans, credit cards, and other financial products, as well as secure better interest rates and terms. Having a good credit score is important because it can affect your ability to rent an apartment, buy a car, or even get a job. Lenders, landlords, and employers often use credit scores to evaluate your financial responsibility and trustworthiness. Understanding your credit score and how it's calculated is key to managing your finances and making informed decisions about borrowing and spending. Now that we have a clearer understanding of what a credit score is, let's explore some common myths surrounding this aspect of personal finance. Myth number 1. Checking your credit score lowers it. One of the most common misconceptions about credit scores is that checking your own score can lower it. In reality, when you check your own credit score, it's considered a soft inquiry, which does not affect your score at all. Soft inquiries are simply a way for you to monitor your financial health and see where you stand. On the other hand, hard inquiries, which occur when a lender checks your credit score as part of a loan or credit card application, can have a small impact on your credit score. This is because hard inquiries indicate to lenders that you may be taking on new debt, which can be a risk factor. It's important to distinguish between these two types of inquiries. Checking your own credit score regularly is a responsible financial habit and can help you catch any errors or fraudulent activity on your report. So, don't be afraid to check your credit score. It won't hurt your score at all. Myth number 2. Closing credit cards improves your score. Closing a credit card account can actually harm your credit score, and here's why. One factor that influences your credit score is the length of your credit history. When you close a credit card account, especially one that you've had for a long time, you're essentially shortening your credit history. This can have a negative impact on your credit score because a longer credit history is generally seen as more favorable by lenders. Another way closing a credit card can hurt your score is by affecting your credit utilization ratio. This ratio is the amount of credit you're using compared to your total available credit. When you close a credit card account, your total available credit decreases, which can cause your credit utilization ratio to increase. A higher credit utilization ratio can signal to lenders that you're relying too heavily on credit, which can lower your credit score. It's important to keep credit card accounts open, even if you're not using them regularly, to maintain a good credit history and a healthy credit utilization ratio. If you're considering closing a credit card account, weigh the potential impact on your credit score carefully and consider keeping the account open if it won't negatively affect your financial situation. Myth number 3. Paying off debt erases it from your credit report. While paying off debt is a positive step towards improving your financial health, it doesn't automatically remove the debt from your credit report. Your credit report is a detailed record of your credit history, including both positive and negative information, and it's used by lenders to assess your credit worthiness. Closed accounts and late payments can stay on your credit report for a certain period, typically 7 years from the date of the first delinquency. This means that even after you've paid off a debt or closed an account, the record of that debt or account can remain on your credit report for up to 7 years. It's important to note that while negative information can stay on your credit report for several years, its impact on your credit score diminishes over time. By consistently making on-time payments and practicing responsible credit management, you can demonstrate to lenders that you're a reliable borrower, even if you have some negative information on your credit report. Are these myths familiar to you? Stay tuned for the next 2, as they are also common misconceptions about credit scores. Understanding them will help you maintain good standing with financial institutions and improve your financial health. Don't forget to subscribe to our channel and hit the bell icon to receive notifications when we release more videos like this. Now let's move on to myth number 4. You need to carry a balance to improve your score. Contrary to popular belief, you do not need to carry a balance on your credit cards to improve your credit score. In fact, carrying a balance can lead to unnecessary interest charges and potentially harm your credit score. What's more important for your credit score is responsible credit card use. This includes making on-time payments, keeping your credit card balances low, and using credit wisely. By paying your credit card balances in full each month, you can demonstrate to lenders that you're able to manage credit responsibly, which can have a positive impact on your credit score. Paying your credit card balances in full also helps keep your credit utilization ratio low, which is the amount of credit you're using compared to your total available credit. A lower credit utilization ratio is generally seen as more favorable by lenders and can help improve your credit score. Myth 5. Income affects your credit score. It's a common misconception that your income directly impacts your credit score. However, this is not the case. Your income is not included in your credit report and therefore does not affect your credit score. While your income is important for other financial matters, such as applying for loans or credit cards, it does not play a role in determining your credit score. Instead, your credit score is based on factors such as your payment history, credit utilization, length of credit history, types of credit accounts, and new credit inquiries. Payment history is one of the most significant factors affecting your credit score. Making on-time payments consistently is crucial for maintaining a good credit score. Credit utilization, which is the amount of credit you're using compared to your total available credit, is another important factor. Keeping your credit card balances low relative to your credit limits can help improve your credit score. Other factors that influence your credit score include the length of your credit history, the types of credit accounts you have, and any new credit inquiries. By understanding these factors and managing your credit responsibly, you can work towards improving your credit score over time. Having learned about these common myths, you're likely aware of what's required to maintain a healthy credit score. Let's elaborate on that with some tips to help improve your credit score if that's a goal you're pursuing. Improving your credit score doesn't have to be complicated. By following these simple tips, you can take control of your credit and work towards a healthier financial future. Tips for improving your credit score. Number 1. Pay bills on time. Your payment history is one of the most important factors in determining your credit score. Make sure to pay all your bills, including credit card bills, loans, and utility bills, on time each month. Tip number 2. Keep credit card balances low. Aim to keep your credit card balances below 30% of your credit limit. Keeping your balances low can help improve your credit utilization ratio, which is an important factor in your credit score. Tip number 3. Open new credit accounts only when needed. While having a mix of credit accounts can be beneficial for your credit score, it's important not to open new accounts unnecessarily. Each new account can temporarily lower your average account age, which can negatively impact your credit score. 4. Regularly check your credit report for errors. Mistakes on your credit report can negatively impact your credit score. Regularly check your credit report from all 3 major credit bureaus, Equifax, Experian, and TransUnion, for any errors or inaccuracies. If you find any, dispute them immediately to have them corrected. By following these tips and practicing responsible credit management, you can improve your credit score over time and open up more opportunities for financial success. Congratulations on making it this far. Your commitment to improving your financial literacy and making informed decisions is a significant stride toward a successful financial journey. Share this video with those who are just beginning their journey or seeking to enhance their credit score health and understanding. Thank you for watching, and until next time, take care.